in general have seen a massive derating from where they were versus where they are right now. Sanjay Mookim joins us, strategist with BoFA ML. Sanjay, good morning. Thank you for joining us. Are you getting a sense that in general one should not be buying PSU stocks? The promise that they were cheap and the promise that the administration is going to be doing everything which would be market friendly and policy friendly, that basic thesis has cracked.
Good morning. Well, I would refrain from making such a broad statement on a basket basis, but it has seemed to be the case that the fiscal pressures that the government is coming under now, getting into a high oil price environment, getting into elections and spending being higher than expected, seems to be translating down to some public sector companies. Okay, so it's a combination of a global commodity regime with oil prices and the oil companies as a result, and fiscal pressures on government, which constrains the behavior of government in relation to their companies. In many respects, you can argue that the public sector, at least at the banks basis, may have bottomed out. So if you look at the fourth quarter, banks in India have taken gross NPAs about $23 billion. PSU banks have reported a bottom line negative of almost $9.7 billion for one quarter. And this is, of course, hopefully a temporary one-off, and you should get better earnings numbers and better growth from PSU banks going forward as well. So there are obviously business cases and bottom-up arguments to make for each company, but the top-down argument that government's own pressures are translating onto its companies does seem to be a little bit true, unfortunately.
You see, where I'm coming from, Sanjay, is very simple. That if I look at the market positioning in 2017 for non-bank PSU companies or non-bank PSU enterprise, they started trading at decent premiums. They had started commanding P multiples which were at par or almost nearing P multiples of private sector, whether it was stocks like HPCL, BPCL, or whether it was BAL or BML. But the way price action has moved this year, that premium which some of the PSU stocks were enjoying, or that P expansion which happened for some of the PSU stocks, that is getting diluted.
See, there are two distinct answers to that. One is the behavior of the market itself and the perceptions or fears of shareholders, which is frankly very short-termist, and these perceptions can change dramatically in a period of months, as we have seen them happen. And the other question really is the business performance. Do public sector management have the same freedoms or even the same incentives that private sector do? And I think the answer to the latter, unfortunately, is perhaps not, because the incentive system for public sector is still not as market oriented as private sector might be. And that expectations versus reality mismatch, I think, had gotten skewed, where the market had started to believe that the public sector might deliver similar returns or similar behavior as the private sector over a consistent period of time. And that's come back down to reality, I suppose.
Sanjay, hi, morning. So let's move away from what really has happened with some of these public sector undertakings, and let's talk about the overall scenario right now. You know, we were just chatting that start of the year just about everything was hunky-dory, and then came the series of bad headlines beginning from LTCG, SEBI changing the regulations and definitions for large, mid and small caps, and thereby mutual funds had to make many adjustments, and repercussions of which are still being felt across. And so much really the dynamism of the global texture is changing, money getting more expensive, central banks across the world hiking interest rates, crude current account deficit for us back home. Just so much has changed. But within that, would you say that at least there are niche pockets wherein yellow weeds are emerging? There are trends which are now beginning to show an improvement. Cement, for instance, channel checks recently seem to be indicating that there have been certain price hikes which have been undertaking. Pricing power is really coming back to the sector. Are you also beginning to see things looking up and the dark clouds really receding now?
Good morning. So yes, I think that characterization is correct in that there are improving signs from a few areas of the economy. So micro indicators or green shoots, as we would love to call them, do seem to be sprouting. And apart from the cement that you're talking about, I could point to the electricity demand growth. I could also say that rail freights in India are going up, and these two are part of the Li Keqiang indicator that people famously use for China, for example. And many conversations with companies are also pointing to the fact that rural demand seems to be on the ascent. Therefore, coming off a low base, coming off a difficult period, I would say in the economy, there does seem to be the fact that micro bottom-up indicators are looking a little better than they were before. The catch there, unfortunately, is that they may not be sufficient to drive stock return. An analysis we did recently, we kind of demonstrated that earnings growth in itself is not sufficient for stock return in a one-year period. What you need to see is earnings beats. So are companies going to deliver numbers or profits better than sell side or street expectations? And that is critical to delivering stock upside or downside from a one-year investment horizon. And my worry is that even though you are seeing an improvement bottom up, those may not be sufficient enough to drive beats given that expectations have become super high. So as a result, yes, we would characterize the environment as a tough macro, but an improving micro. However, the improving micro may not drive the stock market up now.
Next one here, Sanjay, how do you capital protect? Do you only look at large caps because that's really where all the flows seem to be concentrated? Do you completely steer clear from mid and small caps, or you even profit take within large caps? Because, you know, now globally things are beginning to get wobbly. Up until now, you know, things were status quo when it came to at least the US equities, but you don't know whether there's going to be weakness there and that's going to rub off further on us.
Well, I think the question is to be answered saying that it is a question of when, not if, in that a global risk appetite reversion is likely, and we started to see parts of that happen. Outflows from emerging markets have started to pick up pace, especially with the strong dollar and the rising bond yields and so on. We've known this, at least theoretical pitch, for quite a while. Is it now? Is it going to be 6 months from now? Is really the debate that we have to answer. So the framework top down is to say we think equity prices will go down, largely because, you know, the upsides that we got last year had a lot of multiple re-rating in it as well, which needs to recede. So yes, if you can avoid equity, especially from a short-term investment point of view, you should. However, we also flip that around and say if you are a long-term investor, if you have the patience and the appetite to stay invested for a 3, 5, 7 year horizon, then every correction in India is a buying opportunity, because our research also suggests that India works, that the bottom-up income growth momentum is strong, that standards of living will continue to improve, and if you do get equity cheaper, then you should just keep adding. In the near term, of course, we think the risks for mid-caps are continued. Even now, the premiums for mid-caps are at highs relative to large caps. Even though you've seen a correction, it's not corrected any meaningful amount yet.
Sanjay, how are you selling the Indian financial story to global investors? Because if I was sitting outside of India, it would just seem like a very, very murky picture. The handful of banks which are of good quality are trading at expensive valuations. That's the case with NBFCs as well, where, you know, we haven't quite seen the tipping point when it comes to defaults rising, even though people believe that that could be a case on the horizon. But I think NBFCs have done a pretty good job at managing their asset quality thus far. We know what's happening with the corporate banks, and we know what's happening with PSU banks. How do you convince them of a value story in financials? You've also highlighted that financials are to still drive earnings.
Right. So look, it's a very clear case of two different worlds in the financials. One is companies which are doing well, banks which are delivering very strong retail lending growth and limited NPAs, which are therefore as a consequence significantly expensive. And then there is the second large bunch of companies which are not delivering growth, or let's say at least the retail book is growing, but the overall growth is slow, and those which have big balance sheet problems as well. It is very difficult now, unfortunately, to convince people to look at the second set, to say that, look, things have bottomed out, things may get better for the NPA problems of Indian banks, and I suspect that most interest in that will come with a lag. Only once it is proven that slippages have stopped and that you have seen to see meaningful improvement on the balance sheet side of many of these banks, is it likely that investor interest might improve? Because frankly, we've been calling the bottom for a year and a half now, and it's missed our deadlines a couple of times. So I suspect that investor interest in the larger set of weaker banks might take a while.
How convinced are investors about the consumption story in India? Where are we in the consumption cycle right now? I know penetration levels still have much headroom, and so perhaps there is interest still. But from a valuation standpoint, we were just discussing the potential of Horlicks being on sale, and big brands looking at diversifying or getting into the rural markets by making these acquisitions on a time-wise basis. How convinced are they of buying certainty at a price in the consumer market?
Well, again, this answer has two parts. One is the business momentum itself. In the near term, we think that the consumer demand scenario is looking better. And of course, this is not new now. A lot of businesses have come out and said that rural consumption, in fact, is starting to look much stronger than it was before. And we have also in our research argued that the long-term consumption outlook for India remains robust. There is a significant evidence of India moving up the Maslow's hierarchy. We are no longer caught in that low-income trap of having to worry about survival for most of our population, which is a very, very good sign. The second part of that answer, unfortunately, is prices. Everything has a right price. And in the recent note, we've actually reduced our weight on Indian staples. This we did simply because there is a very noticeable divergence in the behavior of Indian consumers now versus global consumers. So what you will notice for most sectors, whether it is industrials or financials or discretionary or materials, the multiples of Indian companies tend to move in line with the multiples in emerging markets. And the correlations are almost 80, 90, 100%. Okay. Only for consumer staples for the last 2 or 3 quarters have we seen a divergence where EM staples are flat, Indian staples continue to re-rate, whereas global staples actually have started to come off in terms of valuations. This disconnect is very jarring to my mind, and this is coming at a time when forward earnings expectations continue to get upgraded in India. So you're getting Indian staples now at a particularly high multiple and a very high growth estimate as well. And you typically do not tend to make too much profit when expectations reach that kind of divergence. So while we like the top line story for consumers, we've actually reduced weights on staples recently.
It's also true for Indian retail banks, and again I go back to Indian retail banks. For the longest time I can remember, HDFC Bank has traded at a price to book of about 4 times, and yet it has been the most consistent performer. So do you think somewhere the risk what staples have, where expectations are high, ownership is high and concentration is high, private banks also could see this kind of a pattern where they will grow, but stock prices may not grow in line with the earning estimates also now?
Right, and the answer to that again is going to come with a lag. So the comfort most investors now have with retail banks is consistency of growth. Quarter after quarter, these companies have delivered in bad times as well a very strong earnings growth performance. And as a result, the assumption is that come hell or high water, the growth is relatively secure. And that's why you may not see a multiple re-rating until the growth performance of these banks starts to diminish. We do not have any visibility of that. In fact, our assumption is that for the next 2, 3, 4 years, there is enough headroom, and enough gain of market share from a failing PSU sector for these retail banks to continue to expand. And as a result, the elevated multiples for these might continue because you have to prove the negative in this case rather than prove the positive.
All right, Sanjay, we leave it at that. Thanks very much for joining us this morning with your thoughts, with your India Strategy Report and how you are pitching the India story to your investors.
My pleasure. Thank you.
Okay, that was a great conversation with Sanjay Mookim of BoFA ML. Let's change tracks and touch base with